Hey guys, so little miscommunication this morning. Some people can't make it. So I thought it'd be a great time to go through this bond report. So something I've talked about a bunch is the presentation I went through with All Star Charts. If you guys are actually members there, you've seen you can see the presentation or you've seen the presentation. But I'm just going to walk you through a little bit of it this morning since it's just me. And I thought this presentation was pretty cool. I won't be able to give as many details as I did at the event, but there's some really cool stuff in here. Starting out with the first chart, just looking at bonds. So if we're looking at bonds, very interesting thing here. Basically, what I'm trying to put into what I'm trying to say is people from for the last 40 years have made money buying bonds, basically from 1981 or 82 all the way to 2020. So basically 39 years of making money in bonds. So how do you tell people that it's time to start selling bonds? Time to start moving into other assets, time to start moving into commodities and so on. It's really hard to tell people these things when they've been making money in something for so long. So, and also it's part of the system. RIAs, they don't make money by coming on here and telling you, hey, if you buy, this, you make money, or if you buy this, you make money, or even giving you good performance, does that make them money? So most of the time, if you're looking at any fiduciary or manager, not like a hedge fund manager, we make money based on performance and fees. They make money usually based on fees. So obviously bringing you into a 60-40 portfolio, it sounds safe, it sounds nice, it's what they were taught about in school. And if you continue to stay in these very safe portfolios, you will make money over time. So that's what they kind of tell people over and over again, and how they get them interested in buying things like bonds and 60-40 portfolio. And they've told people for many, many years. And people who are older already know this. If you're 80 years old, that's how much bonds you should own. 80% of your portfolio should be in bonds. If you're younger, if you're our age, they might say, oh, you can be a little bit more aggressive. How old are you? Oh, you're 30 years old. That means 30% of your portfolio should be in bonds. And then when you're 40, which is the average of investors or people starting to put money into RIAs and so on, and Ross and all of these different products. Once you're that age, that's when they go, okay, well, you need to now put money into these things and do the 40%. So that's where you get the 60-40 portfolio. People love the 60-40 portfolio. They swear by it. They say it's the best thing ever because if the market goes down, bonds go up. And if the market's going up, your bonds will be flat and probably not lose much money. But what about in inflationary times? So if we go all the way back, and we have another chart that we found on that Grant actually made from All Star Charts pretty recently. And so this is basically the 1970s is in blue and today is in red. Now, I hate analog charts, I'll be honest. I'm not a big fan of analog charts. I do think they have a time and a place, but I am not the biggest fan of analog charts. So if we look at this analog chart and we go, okay, is the past going to be just like the future? The answer is no. It's always no. Even looking at the chart, the answer is no. But it can give you a good template of what to look for. So looking at here, are we near a bottom in inflation coming down, or is inflation about to start moving back up? I think the answer to that is yes. I think inflation will move up for a lot of reasons for me. The Fed does this thing every single time where they get behind the curve. They start to raise rates when the economy is overheating, or however they're going to put that. And so when the inflation is moving up and the economy is overheating or any of these things, they start to raise rates. And then they start to lower them when we get back to heading towards a recession and so on. This is where you see these crazy rate cuts all the way to zero very quickly. So if we're looking at that and we go, okay, is the Fed are they cutting rates that quickly to zero? No. But any rate cuts right now, with inflation running under the surface, and you people who live in the real world like me all see, hey, did our grocery bills really go down at all? Did go to the gas pump? Is it still around the same levels? Um, coffee prices are actually higher. Sugar prices are higher. So a lot of the food prices are still consistently higher. Meat prices are a lot higher. So if you look at cattle, you look at hogs, they continue to go up in price. So there's a lot of inflation hanging around under the surface, but the way that the Fed measures inflation and why it gets out of control and why they get behind the curve is they measure inflation in a way that's very different from today. So for example, they measure the things that don't matter. The more you measure things that don't matter, obviously inflation would move down. If you take out, food and energy is one of they're famous for taking out food and energy. Yes, if you take out food and energy or any or rent or anything, you could say, okay, well, yes, we have won the war on inflation. Inflation is now moving down. So I think that's a very ridiculous thing to say in this time. And I think that they're continuing to think that they've won the war on inflation. I think they will continue to cut rates. A lot of people are mixed on that since we saw a little bit of a hot print, but I think they'll continue to cut rates until they say they're going to stop cutting. So as they're going to do that, we'll probably see this uptick in inflation like we're seeing here. It might be fast, or it might be very slow and gradual. Either way, keep watching the asset prices. What are we seeing in the asset prices? That's going to matter. So that's going to be the most important thing. So going through a couple things, interesting. One of my favorite things to study as a trader and something in the background that everybody should pay attention to is group psychology or groupthink. If you're looking at groupthink or group psychology, you understand that as the masses go, and masses don't like truth. And this is from Gustave Le Bon. And Gustave Le Bon wrote the book The Crowd. This is the first book on crowd psychology. And basically, Edward Bernays or any type of propaganda that you've ever heard of comes from this guy's book. This guy had some great work back then. He puts together a very interesting book on group psychology and how to manipulate the masses. And so this is a great quote from him. The masses have never thirsted after truth. Whoever can supply them with illusions is easily their master. Whoever attempts to destroy their illusions is always their victim. And this is true. And you have to understand this as a trader in markets. When you're looking at the media, you're looking at different traders, whatever you're looking at, you're going to understand that there's a groupthink thing going on here. Same when you're looking at the election and they're going to drive the election this way. They're going to drive the election that way. If Trump wins, you got to do this. If Harris wins, you got to do this. And really, it's the answer is there already what you need to do. And it's finding the cold hard facts, trading as a good trader, trading through these cold hard facts, whatever your methodology is, if it's fundamental, technical, positioning, whatever that methodology is, that's how you have to do it as a trader. So next one is from Edward Bernays. We are governed, our minds are molded, our tastes forms, and our ideas suggested, largely by men we have never heard of. So why this is a great one from Edward Bernays is, and it's very interesting. I think the documentary is called Century of Self. And this guy lived for a very long time. I think he lived to be about 100 years old. And by the end of his life, he was very candid about a lot of things. The manipulation to get people to buy cigarettes, the manipulation to get people to have fluoridated water supply by using dentists to say this was good for people. It's pretty endless. He was involved in wars and propaganda campaigns to have coups start in many different countries. So he's an incredibly interesting figure in history, and he has a book. There's propaganda book. There's crystallizing public opinion. Like it's pretty endless the things you can read on this guy, where he tells you all of these things very publicly. Also, he worked for the Council of Foreign Relations. He was part of the saying "making the world safe for democracy." So using those terms and those terminologies and phrases got people to be manipulated to do specific things that he wanted them to do, whether it was going to war, overthrowing a country that the United States didn't like. There was a lot of different things that this guy was a part of. So definitely check out that or it's not an interview, it's a whole documentary, but Century of Self on Edward Bernays. And then Milgram, which is one of my favorites to talk about. So Stanley Milgram, his quote is, "It is easy to ignore responsibility when one is only an intermediate link in a chain of action." So Stanley Milgram is incredibly interesting for many reasons, and one of the reasons is his study. His study was called the Milgram experiments. I was acting like I was going to come up with a great name for that one. So the Milgram experiments, I think I did actually explain that. So Milgram experiment was very interesting. So you have basically someone sitting in a back room. And so as someone is sitting in the back room, so here's the fake subject in the back of the test. So we're looking at this one here on the left side. So the experimenter is the one who's telling them to keep going and keep participating, and the subject is the one administering shocks. The subject has no idea that this is fake. The subject thinks that this is real. So as the experimenter is sitting there and continues to push this on the subject by telling him to keep administering shocks and make him take the test. So basically there's a test that they're taking the whole time, and he's trying to recite words back to him, and the fake subject starts to say them wrong. And the experimenter continues to say, "Hey, shock him." And at a certain point, the subject goes, "Are you sure you want to do that? It sounds like it hurts." Because the fake subject is screaming in the other room. And there's videos on all this stuff. If you guys want to check it out, just Google the Milgram experiments. You can see them. But the subject is basically sitting there, continues to administer shocks, even though at some points the fake subject is pretending to be unresponsive, like it basically died in the other room. And because the experimenter says he has authority, dresses like a doctor, the subject continues to just press the button. And so here's the study. And so the obedience study, it was very interesting results. 26 out of 40 went all the way with 450 volts, and only 5 of them stopped before 300 volts, meaning they were still interested in doing this to a very insane level, no matter what. And most would do it all the way to the end till the person died. And the idea of these studies was to kind of figure out what happened in Nazi Germany. Why would they do this? And so this is just a picture of manipulation. You know, I think that traders have to learn about manipulation more than just about anybody on earth. If you're looking at markets in a way that you think that these people who are writing these things are trying to help you make money, or everybody on Twitter who posts a great trade, that's their entire account looks great every single day because they post a couple great trades a few times a year, and that's the only trades they make are winners. If you think trading is a game of winning, or if you think being right is the same as making money. And what I mean by that is there's a difference with being right. Like, yeah, I could say today the market is probably going to end up higher by the end of the year. I have a high probability of winning that bet. But what about, how do you trade it? How do you do it well? How do you get in and out of trends? How do you buy the breakout? How do you sell it? You know, these things are much more important, or position sizing and risk management. These things are much more important than those things, because the goal in trading is to have a 1 to 5 risk reward. If you're a good trader, long-term trader, meaning you're risking 1% of your overall account to make 5% of your overall account. If you set up your trades this way, you can be wrong a lot and still make money. Wrong is very different than what people think. So if you buy the S&P 500 today, and let's say it hits your stop, you go up, hits your stop loss, you're like, oh, okay, well, my stop loss was hit. Am I completely wrong? No, you just got stopped out. But if you let it get in your head that you're wrong, that you're stupid, that you don't know how to do this, you're going to continue to do that the wrong way. You're going to continue to try to uh, double up on trades and think about how terrible you did because you got a trade wrong. Or if you look at the media and everybody's telling you everybody's making money and you're like, why am I not making money? These are all very important things as a trader that you can understand, learn, and just understand. Hey, if you read the books from the greats, read Market Wizards, read Steve Jobs' book on it's called The House of Money on Soros. These people are right under 50% of the time, sometimes under 40% of the time, sometimes under 30. But these are some of the best traders of our time. So how did they do that? Well, it's with risk management. It's not by listening to the media. It's by making your own ways of diagnosing markets, diagnosing trends, figuring out how to get in and out of positions and position sizing. So this is a great chart. Sam Gatlin made this chart. Sam has some really great work on All Star. But if you look at Sam's chart here, we see this 40-year uptrend. And we also see a 40-year downtrend. And so what I'm pointing to here is that the bond market is very cyclical. It doesn't mean it's going to always look like the past. It doesn't mean the cycles are going to link up perfectly. It means that there's a lot more downward pressure on it through that 40-year cycle after 1981 than upward pressure. And so now we're kind of back into an upcycle. Doesn't mean that yields can't fall at certain points. It means that overall yields should probably move higher. I have nothing wrong with taking a bond trade one direction in the direction of the counter trend trade at the moment. If that comes up, great. It's a great trade to put on. But if you're sitting there and you're not putting on those and you're thinking that it can't, like, we're going to have rates back to zero, the 30 years is going to get back down to 2 or 3%. Mortgage rates are going to come down. If you think everything's going to look like it did during COVID, that's probably the wrong way of looking at it. So what I'm looking at here is more higher highs, higher lows as this trend changes into more of an upward trend going forward. That would be a normal inflationary cycle. And so as we see here, commodities are as cheap as they've ever been to stocks. This is a great chart by AAO Research. And if we look at this chart, we see these crazy price spikes in commodities that have happened over the years. Commodities aren't in vehicles that I want to invest in, or I would tell other people to invest in long term. They are, however, fantastic trading vehicles on the long and the short side. So if you want to make money on the short side of commodities or the long side of commodities, like, you can do that at any time, all the time. But looking at here, now we have this point where compared to equities, commodities are incredibly undervalued. Do I think that it's going to get back to those levels from the dot-com or the financial crisis? I wouldn't be entirely surprised, but with the way that the market has ran, I would be kind of surprised. However, if we look at cycles, that is possible. So the main point of what I'm trying to say here is you want to be involved in commodities in some way. You want to understand how to trade them. Things like gold obviously have been a massive outperformer and could have helped your portfolio a lot this year. So continue to look at commodities, continue to look at things that might be undervalued, breaking to new highs, and so on. These things are going to probably move going forward. And so I showed that chart already when I showed the one from All-Star that we made. So getting to the next one, the CRB to the US 30-year bonds. CRB USB ratio is one of my favorite charts, basically looking at commodity index, which is a lot of energy, which is the reason why you don't see it moving the same way as like gold or something. It really just looks like oil. I think it's nearly 50%, 60% energy these days. So if we look at the CRB to the USB, which is the 30-year bonds, we're seeing this massive downtrend that happened ever since 2008. So we see the dot-com bust, which really triggered this move in commodities the first time. That was a huge cycle. Oil went from $10 all the way to, I think it was 130 or 150 at the peak in 2008. And then it was in a downtrend for many, many years. Oil basically fell off, energy fell off. Stocks, mainly technology, took off. Technology did very bad in the 2000s after the dot-com bust. After that, technology really took off from basically 2009. I think it was March 2009, all the way to today. Technology still looks really good, but there has been some outperformance in the commodity market over the last couple of years. Basically, since 2020, we had a very different thing happen in history. So usually, like, you see the quantitative easing or the Fed lowering rates. Most of that money goes to the bank. The big banks get a lot of that money. They're even incentivized to hold a lot of that money. In 2020, what was different? What was different was you had a bunch of people who kind of came in at that point and said, okay, well, let's shut down the economy. Let's then give money to everybody. And the PPP loans were also pretty insane. You basically could make up a business and get a PPP loan. So a lot of people got a lot of money all at once. And this money went into the market very quickly, which boosted used car prices, new car prices, housing prices, prices for all commodities, basically, on top of the fact that we shut down the economy and created a lot of supply gluts. So on top of all of those things, we saw this huge move in the commodity space right off of that low in 2020 when oil went from negative $50 in the front month contract, really $10 in the in the actual spot market. But so very similar to that dot-com bust, all the way to 130 at the top in 2020, or sorry, in 2022. So next chart, I really love this chart. So the relationship between the Dow Jones Industrials to crude oil. And so we see oil price hit single digits, and that was what I talked about earlier, the oil hitting just under $10 in 1999, which really spiked that rally. And then we saw the same thing in 2020. Oil spot market, the front month went negative 50, spot market went under $10. And then we saw this huge move off of the lows, that huge move all the way till the Russia-Ukraine war. And then the Dow Jones starts outperforming again. I think that was in October 2022. Yes, October 2022. If you guys also look at my YouTube, there's a video for October bottoms. I just posted about it recently. The link looked dead, so let me remake that link for you guys. But it's very important to understand what we were seeing at that point, where the market was headed, and how we headed a lot higher here, and kind of moved off of that inflationary run that we had since 2020, and into more of a bottoming out market for equities. As equities continued higher, we saw things like technology start to lead again, which hadn't happened in years. Semiconductors and the AI trade really took off. So moving to the next chart. This was the positioning at the time, and All-Star puts these out a lot. I share a lot of stuff on the COT reports as well. So looking at the All-Star commitment of traders heat map, if we look at heating oil, it was at 100%. It's still, I think it's at 99% now. So what we're looking at here is what the commercials are doing, the producers are doing. And they're buying the crap out of energy at these points. And so right when I did this presentation, we talked about the fact that if we were going to see energy bottom, it was going to happen soon. It was either not going to bottom and continue breakout, or was going to happen very quickly. Seems like energy has bottomed, but once again, it's not a 100% thing just yet. But I look at it and I go, okay, there's evidence that energy could bottom. There's evidence that yields have started to rise again. There's evidence that the TIPS ETF, which is a Treasury Inflation Protected Securities, have started to move higher again too. Real yields also are starting to move higher. All of these things are pointing towards higher energy prices going forward. So this is an ugly chart because I wanted to make a note on this, but a lot of people are very confused about inflation and gold and bonds. And gold, even though people go, well, gold has to move up in inflationary environments. You're not 100% wrong on that. The problem is that gold usually moves first before the crazy inflation gets out of the way. And when the crazy inflation is there, it usually moves sideways. So you're not really losing a ton of money in gold. So think about it. If you go all the way back to 2020 when this all began, before oil really took off, because that was right after the election, before the grains, before sugar, before anything, um, gold was telling you something. And in 2019, it broke out in May or June 2019. So we see this massive breakout in May 2019. We start to move higher. We had that pullback in during COVID, but if you look at this monthly chart, you can't even see it. This because these are closes. We ended up coming down here. We came all the way back to, I want to say we came back to the support zone. We were at 14 or 1500, and then we bounced and went higher. So gold was telling you there that commodity prices were going to start to move higher soon. And so we should continue to pay attention to commodity prices moving higher. And inflation is usually bullish for gold and negative for bonds. In a late cycle environment, though, bonds and gold can move up together. Easing and reducing interest rates and can increase bond prices. So I wrote that funny. Sorry about that, guys. This also leads to concerns of currency depreciation because of low rates and concerns of inflation in the future. This can lead to higher interest rates. So what I'm saying here is gold rings a dinner bell. I say this all the time. It's probably a ridiculous, cheeky phrase because I have tons of terrible phrases that I say all the time. I'm like a 90-year-old man like that. Sorry about that. It's just the way I do it. But if we look at that and go, okay, well, we're in this zone where we see this currency depreciation, people are starting to have thoughts about it. Are they in a point where they're going, okay, currency depreciation, we're all going to die? I don't think so. But I think people are wondering about it. Okay, if we have inflation, if we're cutting rates with inflation, if you do all of these things together, you're going to have a down dollar. So what is that going to lead to? Well, it usually is going to start the commodity cycle. So inflation rates will continue to move higher. And gold has really been the outperformer. If you look at the commodities ratio and stuff, yes, the commodities don't look great compared to stocks. But if you look at gold compared to stocks, gold has actually held up really well over the years. So this was before the Fed even cut rates. And the reason why the Fed had to cut rates at this point is look how far the 2 years away. So if you really want to see what the Fed's going to do going forward and how to really measure it, look at the 2-year yield to the Fed rate. Fed rates all the way was all the way up there. I think it was between 5.5 and 25 basis points and 5.5. So it was all the way up there back then. But the 2-year yield's all the way down at 3.6. So what do they have to do to get down there? Well, when I say they had to cut over 100 basis points, I wasn't kidding. It's nearly 200. You know, they're almost at 200 basis points at that point. So they cut rates into a cycle that kind of looks inflationary, and the market's fine. It's very rare that they cut rates when the market is this strong. I've only seen it a few times in history, but it's very rare that that happens. This time it is happening. They're cutting rates into a strong, I wouldn't say strong economy. Anybody who sees the real world wouldn't say it's a strong economy, but into a strong market. And so here's the Treasury bond ETF. So even though I am saying, hey, I'm not super bullish long-term on treasuries, because I think that this downtrend will probably sustain. I don't think we're going to get back above these old highs here or even really break this level at 140. I do think that maybe, you know, we see some bounces here and there as the market gets excited about what the Fed's doing and so on. This is a new 52-week high in treasury bonds. So it is possible. However, at the same time as this happened, and for my subscribers, you guys saw that we did get a short signal on bond futures and the TLT. So we did short it. That has worked out really well. And so let's talk about the election a little bit. So talking about the election, I just posted something on my page talking about the media and how I hate the media. And the reason why is that so many people tune to it and try to learn exactly what they need to do from it. And then they end up going, okay, well, this is what I'm going to do. For example, 2020's the easiest, greatest example I've ever found. 2020, basically, there was two camps. One was, we're all going to die. I'm hanging out with friends. I'm going to places where people are talking about ways to get out of the country. All of these things were going to happen that election, and it didn't matter if they were right or left. Everything was going to be bad, and we were all going to die. The election then happens, and the market skyrockets afterwards, just like normal. It usually goes up higher after an election, usually led by things like small caps. So we saw that. Solid move out of the election. The other part of it was when you're looking at as an analyst, people were writing two different camps. So basically, the one camp was, if Trump wins, this is what's going to happen. So if Trump wins the election, you need to buy energy, banks, industrials. That's because Donald Trump is going to boost the economy and do these things, and that's how it's going to happen. And then it was the opposite for Biden. If Biden won, you wanted to buy technology, solar, anything that was basically technology based, because he was going to help technology. What happened after the election? The opposite. Biden gets in, energy skyrockets, oil skyrockets. Basically, everything that was giving signals in the first place all skyrocketed as well. So as we saw that, that's where that market ended up. So it was very interesting times. Just wanted to end on the election. We got one coming up. I think that it's going to be a very interesting one coming up right now. I would say that most likely the market will just head higher afterwards, and vol will crush. And everybody's going to have an opinion before that. So fade the fear. KG, fade the fear. KG is here.
Hey, can you hear me? All right.
Yeah.
All right, man. My bad.
You're good, dude. I'm excited you made it, dude. Thanks for coming on.
Oh man, I hopped in here. Hey, I only got the tail end of that. Wanted to jump in here real quick. So what were you kind of talking about when it comes to the election risk? Are you saying that we might see some vol going into it, or what's the kind of setup there? I'm sorry for having you.
No, you're good. So basically, I mean, this is what I love about doing the social media stuff like this, because it's just real life. Like, some people are busy. You guys are going to see my dogs running around and cats and my wife. Like, all of these things are just going to kind of happen in the background. So, as all of this is just happening, just understand where we're at. So anyways, Kevin, I was just talking about the bond market. So when we're talking about the bond market, I was just talking about the fact that I think overall we're probably in a down cycle in the bond market. I went through a little bit of my presentation from it, a couple things on public relations and group psychology and so on. So, but we don't have to talk about any of that. We could talk about what you think about just the election. What are you thinking here?
Look, I think we've already seen that the buildup in the volatility for the October contract, right? That's been there for a very long time if you're looking at the VIX curve. And I actually do recommend a lot of people, if you are trading, especially if you're trading futures, to look at any curve for futures contracts, because they'll kind of give you a little bit more insights as to what the market's looking at for the future. So we've always had this like little kink within the VIX futures curve for pretty much around 3 to 4 months. And now we're actually seeing an elevated realized, I want to say realized, elevated spot VIX, right? The VIX, right? The next 30 days implied vol is obviously still elevated, even though we have, let's say decent data, okay data, and the market's literally hitting all-time highs. On a relative basis, volatility is still high. And I expect that will continue to be high until the election. Now, here's the thing. If we want to get really in the weeds with it, generally, we see election vol actually drop before the election, like a week to 2 weeks before, because usually the polls will solidify the majority of power. That doesn't mean the presidency, right? There's three things that we're got to have control over, right? We have the Senate, you have the House, you have the presidency. You have the House that actually controls the money. That's very important when it comes to budgetary spend. You have the Senate that's going to have to obviously kind of go through that approval process. And then obviously you have the executive branch. So usually we'll see like a little bit of a drop off in vol. I'm not sure if we're actually going to see that right now because it's just the races are so tight. I'm seeing people today, Trump's going to win by a landslide. That's not, look, no one knows. The polls in the very key states are way too close right now for anybody to tell. And when you're looking at some of the splits on down ballot, especially when you're looking at the Senate, some of these races that are leaning towards Trump, and I'm not a Trump hater because I'm going to give you guys a little bit of spin here. Let's say Arizona, right? So Arizona, you have Carrie Lake running. I think she's down like 12 to 15 percentage points down. It doesn't look like she's going to win, right? But it does have Trump being able to favor. To see a 15% split in a vote on the general is very highly unlikely. Usually that doesn't happen. So either Carrie Lake's going to outperform. I'm not saying that she's going to win, but maybe she's going to outperform, or Trump may lose Arizona. It might be tighter than what we expect. North Carolina is a really good case too. Now that's a unique one because they have obviously that gentleman that's going up right now. I believe for the governorship, that's kind of dragging down the down ballots, and he's got some wild stuff going on. Some wild stuff, but massive divergence between maybe 50-50 Kamala Trump, right? But when you're kind of looking at that race, that guy's down. He's only getting like 30%, 32, 35% of the vote in the polling. And pollings can be wrong, but we usually don't see that much of a split. So if we do have that type of split taking place, and if we do have a scenario where Georgia is not the deciding factor for the election vol, what up, Em? Election vol is going to drop, right? Completely off the map. Georgia's the key. And I'm not saying Georgia battleground. I'll just tell you the mechanics. They're about to potentially, there's still a battle here. They're about to potentially hand count all of their ballots within their state, which is going to take weeks, if not months. And the Secretary of State, which is on the Republican side, is actually challenging the election board's decision to actually do this, right? Like this is kind of like an in-party fight that's actually going on. It's not a Dem versus this is actually all in-house. But if it comes down to Georgia, that uncertainty and how long it's going to take, and then also the court battles that are going to ensue, we already know that it's going to be a hot mess. We already know what we're going to get into. But the addition of that in the time that it's going to take, if that's going to be the deciding state, that's where I think you get black swan risk vol for the VIX itself, right? Now, vol also does not mean markets go down. It doesn't always mean that markets go down. It means that markets, when we talk about volatility, it's the move or the move in price, the extreme moves to the upside or downside, right? It doesn't mean, oh man, high vol up, sell off the markets. In high vol environments, you actually want to kind of sell premium, right? And sometimes
that's a good thing to talk about, Kevin, too, is just talking about implied volatility. You know, like you just said, it's the implied move. So, you know, when you're looking at that as a trader and you're looking at the VIX, can you say, you know, like, I know you can do this very easily, but I'm just kind of leading you here because I know people would be interested because a lot of people don't know. So if you're looking at the S&P 500 and then you're looking at the VIX at a 20, what's the implied move of the S&P?
Yeah, the implied move is roughly around 1.25%. So you take the actual VIX and you divide it by 16. The actual calculation, because somebody, JC called me out on this. The actual calculations, the square root of 252, which is 252 trading days, divided by the VIX, which is roughly around 16. It's like 15.85 something, blah, blah, blah. Round it up, make it really easy. That would be around a 1.25% implied move. Once again, that doesn't mean 1.25% to the upside. It doesn't mean 1.25% to the downside. It means range of price action is being priced in, and that's a 66.7% probability that it's going to stay within that price range. Now, you're going to have that, 33% or so where it can go outside of those bands, and that's where you have realized vol higher than implied vol, right? And those are those type of markets where they provide really great opportunities. And when you have high volatility markets, volatility on a longer time frame, guys, volatility will always go down over time. right? And times, not we can't just say like, oh, well, at this point in time, it stayed up elevated. No, like you can look at vol, and vol eventually, the markets will eventually digest fear, uncertainty, and risk. And they'll price that into their models, and then we'll see that backed out. We talk about geopolitical risk, right? Russia-Ukraine conflict, boom, huge spike in vol, huge spike in all vol across the curve. If you're looking at oil vol, nat gas vol, not even just talking about equities, right?
Treasury
Grains,
vol,
treasury vol, right? Grains, which remind me about grains here in a second, but eventually the market's going to say, okay, this is an event that is occurring. It doesn't look like it's going to subside, but we know it's there. We realize that. We're going to bring that into our calculations, right? I hate saying it like this is a really bad thing to say. We eventually live with it, just like what we are seeing right now in Israel and Iran and Lebanon. Unfortunate situation. I hope it doesn't escalate on all sides, right? I don't like seeing people die. But if that conflict continues to go on for a very long time, eventually we're going to price that into vol, right? And so that's kind of what I mean. Back to what I was talking about, election risk vol right now, the trade, I don't want to say it's busted, but I brought this up around 4 weeks ago, when VIX was sitting at around 15-ish, 16.5-ish, give or take, right? And so if you were looking at the November 20th at the money calls for VIX, they're only going for like $3.50. Now that November contract is going to be priced off the November future. So you have to also understand that there's a little bit of a backwardation that's taking place. Once again, election falls in October, not so much in November, but you can get a re-rating, right? You can get a fractured shift to, reversal if you have that scenario that I was talking about. Right. If Kamala Harris, basically, this is what I gotta say. If Kamala Harris does not sweep Michigan, Wisconsin, and PA, and we don't have that deciding, well, at least if she can't get the northern states, ex-PA, because PA is going to take a little bit of time, but we would be able to see where they're leaning out of 4 different counties. Like, it doesn't take that much, right? But if she doesn't really sweep the north and she doesn't get Arizona, then I think that's where you see the vol risk. Then it's going to come down to GA, right? And so that's where you got the vol.
Nice. No, perfect. Let's hop into the grains because you said don't let me forget about the grains, and I was like, don't worry, Kevin, I'm gonna get to the grains. so what are you thinking about the grains?
Yeah, look, be mindful of it. So Russia has attacked 3 commercial vessels. They haven't taken any of them down, but you're starting to see a little bit more of an escalation. When you're looking at grain shipments from the Black Sea, right? This is a scenario here where they've been fighting. They're lobbing bombs back and forth with each other, right? They're droning and doing all this stuff. But there was an agreement that the grain trade would persist because obviously they're a huge supplier to the east, right? Especially when you're looking at India or even when you're looking at Africa supplies, such as for Russia. But it seems like Russia now is starting to attack a lot more of those commercial vessels. And if that's going to be a risk out there and they're unable to ship supply, that could actually have a little bit of an impact when it comes to logistics. And there could be a logistics premium that's being built in. Now, let me say this. There is still ample amount of supply out there for soybeans, for wheat. Let's not get that twisted. The fundamentals still say that there's a lot of inventory that's out there, a lot of inventory and stockpiles. And then we actually had a pretty decent harvest. I believe Russia actually did readjust their wheat production targets for 2025 to the downside minimally, right? So that would be one to kind of keep on your radar. But if those attacks continue to ramp up, that can be actually that could be somewhat of a problem. When I say a problem, that could be something that would cause a little bit more uncertainty when it comes to the grain trade, specifically wheat and beans. So be mindful of that. That just started happening over the last 3 days or so. Yeah, but that is something that's a little bit concerning here. And Ukraine really doesn't have any other avenues to really get the grains out there. For those that actually do not know, so to the east of Ukraine, right, they have all of these European partners, Poland and everybody, right? But there's like a huge dispute. They do not want to have Ukrainian grain in their markets. Like that's actually one of the biggest sticking points for, we'll call it the West, but let's call it the European nations. They'll back them 99%, pretty much with almost everything else. But there's a 1% out there that they're like, no, like there is actually a dispute, and it's a continued dispute within the EU right now. And so that would be an item. Why is soy oil not trading like other soy meal and soybeans? So soy oil, there was a so ADM has a crush operation that was in the path of the hurricane that I know that I believe that they took offline. And then there's going to always be like these labor disputes that you're seeing in South America, Central and South America, right? And South America has a really robust crush operation. So I would just kind of like chalk that up for now. But outside of that, I don't have any other reason why bean oil is acting in the manner that it is.
Yeah, I've seen that lately too. Is, once again, here's the thing that's very hard to say that like a lot of people wouldn't want to say, but I'll be very honest. As a commodities trader, there's a reason why I use systems and I use breakout systems and trading strategies, because sometimes some of these products, once again, if you're going to be a real diversified trend follower and you're going to have 20 different futures products that you're trading in the commodity space like that, you're not going to know every single thing that happens. But what you can know is, what's the positioning? What's the price doing? Am I getting a signal or not? And right now, like a lot of them, we don't have signals, but what's starting to come into play and where we're seeing signals already, and like KG's been talking about, we've been talking about wheat and the grains for a while. They look like they finally have a setup to possibly bottom. I would be very interested in continuing to pay attention to that setup. Things like soybean oil, soy oil, as interesting as it is, it's a very few people trade it. So I've always loved that you bring up soybean oil, because I never hear about soy oil unless you bring it up, because very few people trade it. But things like soybeans, corn, wheat, these are the things that I would have on your models right now, paying attention to, looking for signals to buy these things. There's a lot of them kind of coming into play. Go ahead, Ken.
It is tough though. I also want to kind of
balance some headwinds.
Yeah, there's going to be tough. So you have the seasonal, downward pressure of producers or farmers pretty much, locking in prices, right? Mm-hmm. Especially when you're going to start, positioning for new crop in the March contract. So they're going to be, selling a lot, and so you're kind of going up against the grain for now. But if you kind of
great pun there.
If you have this, if you have a scenario where weather conditions change dramatically, because we're in like the heart of harvest season. We're in pretty much the heart of harvest season for the most part. Midwest, kind of like in Illinois, it's a little weird. And then when you're looking at South America and Brazil, they're starting their new planting season, right? So we got to be mindful of that. So the chart, like if you took the name off the charts, right, and you showed me a chart right now of soy oil, it's coiling, it's basing, but you don't have a breakout until you get 48.5, right? But you got to understand too, you got that seasonal factor that is going to be there. Now, what will most likely happen is that you will also have the closing of those contracts too, right? We have excessive shorts. We actually already have a little bit of short covering that's taking place right now. But if you have, this situation where they start taking off those hedges, that's where you can kind of get that rally. And I would look at the March contract is going to be your the new one to focus on here. I mean, we still have the Ds. You still have a month and a half to trade those. And then you're going to have to make that decision. Do you want to trade, old crop? Do you want to trade new crop? Which the new crop will be later for next year for those contracts. But everything is going to be unique. But in the soy complex right now, it's labor disputes, it's crushing operations. And I want to say, don't hold me to this, guys, but I believe that ADM has has a major crush operation in the South South United States, right? That I think was in the path and or was getting shut down in order to, obviously keep their employees safe. And if I'm not mistaken, it comprises of around 9 to 15%, one of those two numbers, 9 to 15% of all crush operations in the U.S., which is enough to, make a price move. So that's what I meant.
Yeah, so I think that generally looking at this market right now, it's a very interesting time for commodities. And I think that once again, just like you mentioned, Kevin, we have headwinds, but we also have tailwinds. It's one of those things that's like I'd love to just as a trader, it's like you want to know all of these things. You want to know the headwinds, you want to know the tailwinds. I would love to come in here and lie to people like some people do and go, hey, I know 100% this is going to happen, but I know nothing 100%. What I do know is that I'm betting on some upside to happen and continue in wheat and so on. I do think there's headwinds. Short-term traders, you should really pay attention to those headwinds because these rolling of contracts or even understanding because I think this is another thing, and maybe we can talk about this on Monday, Kevin, is understanding which contract you're trading in. This is incredibly important in the futures market, and a lot of people don't ever take this into consideration. Even if you're a technician, I'll watch people try to trade futures and they'll be like, oh, well, I got the signal on my front month contract and the continuous contract. Therefore, now I'm going to move out further on the curve because I want to have more time for my expiration. And it's like, no, that could be very different. Kevin, you had one when we first started talking in natural gas. Great example of this. Kevin said natural gas, the front month is going to bounce, but the rest of it isn't going to do anything. And it didn't do anything. It continued not to do anything. So, and why would something like that happen, Kevin?
Well, it's near-term fears when it comes to supply disruptions. And actually, we're back into that season. Mm-hmm. Basically starting now. I would say probably now or next month. What's interesting about natural gas is that it's getting faded a little bit. The EIA actually had a report out that they basically, are looking at having actually a little bit lower consumption when it comes to natural gas this year because the weather patterns, for the most part, have been a little bit warmer. Right, we're not seeing that frost now. I can tell you this, anecdotally, dude, I don't know what the hell's up with San Francisco. I'm in Santa Clara right now. But man, I was like on that jet and it looks so nice, like the cloud. And then I'm like, dang, there's a lot of clouds down there. And it's like an iceberg over here. Now, obviously, we're at the coast, right? but overall, when you look at the United States, the heating, we're not getting as cool as I think the market kind of expected. So you're seeing that move to the downside. But when we get into the winter months, the Decembers and Januaries and what have you, you will have those times. It's without a doubt here, right? Where that you will get a spike in natty. It's just inevitable. If you get a one of those Arctic blasts that impact North Dakota's production and pipelines themselves, and they're going to have to like flare out and then be able to shut down operations because they don't want to blow anything up. That's where you kind of get those, I don't want to say massive draws, but that's where you kind of get that FOMO feeling, but they'll bid up the front contract because it's a near-term risk. When you have longer-term risk that's being priced into any market, you're going to see that being priced out in the curve, right? Not equally, right? You're still going to have this kind of odd dynamic, especially if that's anything that's in backwardation, meaning that there's more demand for the near-term commodity, no matter what it is, than the long term, right? But you should still see kind of like a rising tides lift all boats type of scenario. And natty, you'll see like this massive disjoining of the contracts here. Those are tough markets because everybody and their mother, when they see them, they're like, oh my God, this is the time. And so if you're not managing that back, if you're not looking at that futures curve and you're not noticing that the spread between the contracts are just massively wide, those will come in at some point, right?
Yeah.
Either the further dated contract has to move up or the front month is going to move down. And for natural gas, not for everything, but for natural gas, the dynamics for that commodity itself or an oversupply, usually it comes down from the front month coming back down and normalizing. So but it's a tough trade. And sometimes you look at it and you'll be like, man, I would love to just sell that spread, right? I would love to sell the front month, buy the future or buy the next month, right? which you would create a spread there, and then you would see that spread widening or closing down. That's what you would do, right? You get more premium on the front. You'd sell the front, get more premium. You buy the back, have that it's kind of like a time spread. But every time it happens, though, it's like the scariest thing that it's the scariest thing to look at, because you're like,
well, because so many people get so excited about it, and you're like, wait, this is very short lived. And like, that's the other thing that's important to understand. If you are going to trade the futures markets and you are looking for the things like KG just talked about, you want to be in the front month contracts. But once again, it's like, you don't want to just, this is why natural gas trading is so hard. You don't want to just hang out in the front month contract hoping that this happens either. So you have to think about it in a bunch of different ways, but these spikes are going to affect the front month contract. A good thing for people to do is look at the later contracts. Did it happen in the December contract, in the March contract, and keep going through them. And maybe if you see a spike that's across the entire board, then you're kind of looking at something that might be sustainable. Yeah. So, all right, guys. Kevin, if you have anything else,
I do have the last thing here. I don't, obviously it literally just hit the wire, but the WASD report did come out for October. It's actually a really good read, guys. You only need to read the first 4 pages, provides you the summary. It's a pretty decent report, but the first 4 pages kind of gives you the rundown of what's actually happening. So you will see grains making a move. And actually, if you kind of look at soybean futures right now, they moved down lower. Let's see what corn's doing. Corn, brief spike, but came back down. Let's see, wheat. Once again, brief spike. So WASD report on a Friday. Nothing better, man. Jason, once again, sorry for me being late, man. I hope everybody has a really good weekend, though. And we will connect on Monday.
Yeah. All right, man. Thanks for making it, and we'll see you guys soon.
Sounds good. See ya.